Today, for the first session of the CGF seminars, the first paper comes from myself and Athina. Athina Petropoulou is a postdoctoral research fellow in the Center for Global Finance here at SOAS. And myself, I'm Victor Murinde, and I'm AXA chair in global finance, and also the director for the Center for Global Finance. I'm looking at the list of participants. I think I have met most of you. I think I happen to know a good number of the people here, if not all of them. Now, for this first research seminar, we are choosing an issue which revolves around fintech, financial technologies. And basically, you could put the title as fintech for everyone. What does fintech mean for you? What does fintech mean for me? What does fintech mean for everyone? What do these financial technologies, especially in the face of multiple shocks, the COVID-19 shock, climate risk shocks, the Russia-Ukraine conflict shocks that have implications for energy prices and prices in general. So the combination of these multiple shocks and some policymakers are looking for technology to be able to help them resolve around this. Maybe, maybe not. But the whole argument is that the fintech revolution is exploiting recent technologies and all these advances in technology to offer some novel applications to transform the entire spectrum of the financial services value chain. But we know that the revolution is in the early stages, and the impact on the behavior of economic agents, for example, households, is not well configured, is not well known. We are still searching for solutions. We are still searching for evidence and new knowledge on how this works. So we have undertaken this research, Athina and myself, and trying to use a workhorse, a very workforce of the flow of funds framework or the flow of funds model, and applying it just to households, that's you and I, and using a novel framework called the almost ideal demand system framework. And then so we can be able to examine how the financial innovation in the form of fintech affects the demand for assets, the supply for assets, and the dynamics of substitution between the assets by households. Now, to do this, we focus on the sample of OECD countries. These constitute the engine of the global economy, the OECD countries, and they provide the largest contributions to growth in recent years. For example, the UK, the EU, the US, Japan, China, Australia. The US contributes about 20.9 of world GDP. EU contributes about 15.5 of GDP, of world GDP. China, 14.09. Japan, 5.03. UK, 2.09. Australia, 1.4. So you see that these OECD economies, which make our sample in this paper, are very influential as engines of growth. And we shall be sharing with you some of the contributions we make. And of course, this is also work in progress. So we shall very much welcome all your comments as we go. I'll start the ball rolling, and I think toward the end, when I finish, I'll bring in Athina if she has something to add. She's just presented this paper at the World Conference, I think last month, and some of the comments might be congruent with the observations you make. So let me share the presentation and start off, but I thought I should just give you a highlight of where we are going this afternoon. And so we give a title of household portfolio preferences. That is the assets owned by households, you and I, which you own and which I own, in the face of the era of financial innovation. And so the presentation will follow the traditional route map, where we give an introduction. We give you a theoretical framework revolving around the flow of funds conceptual framework and the theory of consumption, the almost ideal demand system, which because of the demand for household assets. We specify the empirical model based on that theory. We will also discuss the data that we used. It was painstaking to collect this data, a large data set on OECD countries. We'll give you the indication of the preliminary empirical results. And then we also give you our conclusions so far, tentative conclusions. We don't want to sanctify these conclusions at this stage. So tentative conclusions and the next steps of this work towards completion of the paper. And then we shall invite comments from you. But in the meantime, when I'm presenting, if you get ideas or have a comment, please feel free to put it in the chat. There's a chat space in Teams so that I shall pick up those comments as I go. But if somebody puts up their hand, Athina, please draw it to my attention, because when I'm presenting, actually I can't see the indicator. There is a button of raise hand, which you just click on, and then you have a raised hand for comment. And I can deal with a comment interactively, or I may deal with a comment as we go toward the end of the presentation. So why this paper? In terms of the advances in research, in scientific work, we know that the flow of funds framework provides a very good tool for studying the supply of assets. Assets could be your equity, your bonds, your cash, your currency, any wealth you hold. And then the demand for these assets across households, you and I, firms or companies, banks, or commercial banks, a government, and the rest of the world. There's a cross the sectors, okay? And this framework has been used in the last 50 years in very path-breaking work by Nobel laureates in economics, Nobel Prize winners in economics, such as Lawrence Klein, Richard Stone, James Tobin, have actually drawn from this very important framework. That's the common element of their work. So we are building on the shoulders of giants here. And the common configuration is basically to take a flow of funds framework and translate it into asset demand equations. Okay. Now, we look around all the work so far in the last 50 years, and we find that the best of our knowledge, no work has taken into account financial innovations and how these financial innovations may influence the demand for assets, or indeed the supply of assets for households. So we try to fill this gap, the lacuna and the base that try to interface these innovations with a well-known tested framework of the flow of funds in terms of the demand and supply of a household portfolios for the household. And why fintech? As I mentioned at the start, the discussion before I started sharing the PowerPoints, the financial technologies revolution is a very important revolution, transforming economies and the way we work, transforming human behavior, and was most instrumental, for example, during the global financial crisis, as well as during the COVID-19 lockdown. And the argument is that basically the fintech can transform the provision of financial services, can drive the creation of new business models, new business applications, processes and products. And these innovative services offered by fintech solutions can therefore impact households balance sheets. And mainly as identified by the Bank for International Settlement in 2018, that is the central bank of central banks, three main channels. One is in the new form of payment, as was current during the lockdown, transactions on new financial technologies. Also in terms of lending operations, and therefore the loan assets within the household portfolio may be transformed. Our payments mechanism will affect the smoothness of transactions and then the functionality of the financial system. But the third important element is on investment management. The management of portfolios held by households, portfolios held by companies, portfolios held by banks, portfolios held by governments, and of course, the world and international exchanges of global portfolios operating in London, New York, and all these main cities. So the argument in BIS 2018 is that fintech can impact on household balance sheets through these three main channels. And it could be extended to say, it could also affect, of course, the balance sheet of companies or banks or governments. Okay, but this paper is exclusively on households' balance sheet. And of course, what we have seen is, for example, the changes in the payments technology, with households moving from holding cash to digital payments and mobile money across the world, Africa, Asia, Latin America, and of course, also mostly in the industrial countries where digital payments have a big proportion. For example, in the US, cash accounted for 19% of all payments in 2021, down 7 percentage points from 2019, and the fall being accounted for by the increase in digital payments. In the UK, cash were used to pay for under 20% of sales in value in 2019, but 59% of retailers were being paid by debit cards, which is a form of financial innovation. And in the UK here, 18% of the population are registered for mobile payments such as Apple Pay, Google Pay, and now all these that we use on our phones to undertake all these transactions. So it's true that the changes in payment behavior have been accelerated by changes in payments technology. But of course, as I mentioned, fintech has also transformed the lending processes, and recent work has documented the substitution effects between fintech lenders and traditional banks, especially the work by Tang in 2019. The work by Claessens in 2018 observed that China had the largest fintech credit market, followed by the US and the UK. And you look at in China, all these outfits like Alibaba undertaking huge credit market transactions on fintech platforms. And again, the recent research pointing to transformations in the US, especially the work of Buchak 2018, Foster 2019, and others, is showing that technologies are changing the percentage of unsecured personal loans and also mortgage originations for housing finance, accounting for about 20% of the total about 5 years ago. In the UK, fintech credit has accounted for 50% of the lending flow, and also both for large companies as well as small SMEs. Now, but perhaps it's useful here to give some of the examples on innovations that drive the work in this paper. We are talking about or thinking about in this paper innovations that create investment opportunities for households, that change their portfolio holdings. A portfolio is basically a combination of assets. So the asset holdings of the households change. For example, robo-advisors have shaped the portfolios of household investors. Globally in the OECD countries, with the adoption of robo-advisors, we see that US household investors have increased their bond holdings from 20% to 40% and decreased their cash holdings from 22% to 1%, according to the paper by Rossi and Utkas 2019. So, already you can see these are showing partially how some of these assets have changed and possible substitution between cash holdings, currency holdings, and bond holdings. But as we know, some of these are innovations like crowdfunding. Crowdfunding has risen in the form of equity investing, which opens up a new asset class with the return characteristics and risk characteristics on their profile. So it changes the return risk, asset classifications, and important for household investors who want to take part in the early stage investment opportunities. But most importantly, that this innovation has enabled portfolio diversification benefits. That is, try not to put your eggs in one basket, and how you do diversify across the assets you hold. In other words, make changes in the portfolio for households. What does the literature tell us? Maybe we take excursion and look at the existing literature that traditionally looked at the traditional flow of funds even before consideration of these new technologies. We know that the flow of funds, goes back to the work of Copeland, 1952, much older than all of us here, I guess. And then later on, the framework was comprehensively configured and then incorporated in official statistics run by central banks and Ministry of Finance and by the IMF and the global systems that regulate the functionality of financial institutions and financial markets. First in the US and later adopted within the UN system of national accounts, the SNA, and papers by United Nations 68 and 93 are part of the whole national accounting system. So that when you are looking at accounting for financial transactions in an economy like the UK or the US, you would use this as the basis for tying down the transactions. And most importantly, being able to estimate the uncaptured elements of national economies. But the developments have happened in two main ways, and we need to distinguish these two ways. First is where the flow of funds models are used for economy-wide big models, like the model of the UK economy, versus single sector studies of flow of funds. That is where you take a single sector like households, or you take a single sector like companies, and then you use the flow of funds. Okay, so you could say the big large scale models is a combination of the piecemeal type of looking at single sectors. Okay, but also there has been a way of looking at integrating expenditure models and portfolio models, and especially work by Backus and Purvis early in the 80s and Owen in 1986, tried actually to reasonably bring these together so that you have a configuration of how does the financial sector, how do financial institutions, and how do financial markets or capital markets affect the real side of the economy, affect manufacturing, affect output, affect agriculture and the other sectors. So that's a kind of integrating the real side of the economy and the financial side of the economy. And that's it was a very, very big step forward. Another big step forward was to reconfigure asset demand or the portfolios of households in a way that is comparable or analogous to consumer demand systems. Because consumer demand systems, if they're the consumer for automobiles, the consumer for new houses, the consumer for this is just in the consumption theory, basically consumer theory. It is the consumer, demand systems, and utilize the flexible functions of these systems to be able to study the demand for assets, or even the demand for money. Okay, the demand for money, the demand for deposits, the demand for currency, the demand for bonds, and any other financial assets. And that was a big breakthrough, a continuation in this direction. So what we do in this paper is to build upon all those developments in theory, in conceptualization, in theoretical specification of some of the models, and then specify and estimate a flow of funds model for a single sector, the household sector, using the innovations from consumer theory, that is within the almost ideal demand system framework. And we hope that this framework will provide us an insight into the intersectoral distribution of sources of funds and uses of funds. So that for a household, you say, this is sources of, uses of funds, and then the uses, the sources and uses of funds for a single household. So we'll be able to examine why agents, say for example, households, in a particular sector hold specific assets, and why the agents decide to substitute assets in their portfolios. We therefore estimate a sector-specific model of household sector portfolio choices. Which assets, in other words, which assets do households demand? We then integrate the impact of fintech on the demand for these financial assets and study the dynamics of substitution between these assets. We focus on 5 OECD countries: UK, EU, US, Japan, and Australia. And we hope that this research will shed light on the impact of financial innovation on household portfolio behavior in large economies, which shape the global economic developments. So we could say we have two main contributions in this research. The first is we offer a new interpretation of the demand for financial assets by households, or households portfolio demand by households in the context of financial innovations, and specifically the fintech innovations. But we also use the framework to assess the impact of some of these big shocks like COVID-19 on household portfolio preferences. We are still trying to shape the second contribution in many ways in what we present today. So maybe it would be helpful to first just get some overall insight about what we've been referring to as the flow of funds conceptual framework. What is it that we are trying to do? And this is a very, very simplified fashion, a simplified diagrammatic schema or framework. Could be expanded, especially without expanding the sectors. Financial corporations, okay, include banks and financial institutions, financial markets. A general government, households, you and I, companies, non-financial corporations, and then the rest of the economy. So we are focusing only on households. Okay. When I mentioned that some of these studies could be forms of a general model for an economy, the type of model that central banks and treasuries mount, one would need to incorporate all the 5 sectors, all the 5 dimensions. Now, but also in terms of looking at the assets and the portfolios, and especially taking the assets we just highlight the basic assets, basically the currency you hold, or currency held by households, a bank deposits, which could be banks, the deposits by households, our deposits, my deposits, in a commercial bank or on a form of financial institutions. Then government securities, you buy bonds, treasury bills bought by households, and then equity, the shares in a company by households. Now, you could stretch these to about 20 or 15 or 10, depending on the sophistication of the given economy, or depending on the leverage you want to pay attention to in your modeling exercise. But we just want to focus on these and say on these basic ones. And then you have the liabilities, say in terms of loans, basically, on the balance sheet accounts. And then, of course, everything turns up in the net worth, which should be able to balance out to 100%. So everything should sum up. So there is a way of allowing for that everything will sum up in a flow of funds conceptual framework. Now, given that kind of framework an accounting metrics that we have just presented, the idea is in terms of the theory is basically to build from this flow of funds to be able to specify asset demand equations. Okay, so I have a flow of funds model, and that each cell in the matrix contains a variable which can be explained by asset demand equations. And these asset demand equations, we have explanatory variables that include interest rates and other variables. So for each asset, say suppose you take deposits, the demand for deposits will depend on the interest rate on those deposits, okay, and then the other variables, of course, okay. And so we are looking at a way of building a demand equation. We can, of course, what we do is adopt the almost ideal demand system, harking back from the work of Denton and Molaba in 1980 in the American Economic Review, which explains a way in which demand systems are configured. We apply this to financial assets, and in that framework of financial assets, we explain the importance of financial technologies in the demand for assets. Now, the almost ideal demand system of Angus Deaton and John Molaba in 1980 is based on a first specification of a cost function, the second function, where basically you are looking at the cost and then aggregation of costs, aggregation of prices, and then you have, of course, an aggregation of a number of a configuration of prices over the factors that you have in the function, and then in any other substance. So P stands for the price of goods, and U is the utility level. So basically the utility function for this. And it is possible to expand this as done by Will in 1986, whereby auxiliary variables may influence the demand for particular financial instruments. And so they can be included in the baseline holdings. So the cost function can be augmented. The part of Denton and Molaba, the part of Denton and Molaba, and then you are augmenting it with other considerations, with other factors and other auxiliary variables, which you consider so important for the demand system for financial assets. So our theory builds on this specification. And from this, one can then use Shepard's lemma to derive demand equations, because that's actually put in terms of asset shares. So you have, for example, SI is the share of a given asset, the share, say, of currency in total assets, the share of currency in your portfolio, the share of deposits in your portfolio, the share of loans in your portfolio. Okay, so that this share, okay, that's why they call it share equation. This share, you're actually looking at the prices of, say, the price of deposits, that will be interest rates, and then any other factors. And then you have the worth effects, the total worth, as in the portfolio. So this model is tractable theoretically because based on theoretical assumptions, all budget shares some unity. That's called the additionality restrictions. And a proportional change in all the prices and expenditure have no effect on quantities purchased. That's the homogeneity, principle. And then all household choices are consistent. So now, basing on this theoretical framework, here what we present are the asset share equations for our model in this paper. So our asset share equation can be specified as a system, as a simultaneous system of equations in the form here, producing a general model, which include the additional factor of fintech, okay? And these can be then, of course, computed as a seemingly unregulated regression model following the work of Arnold Zellner in the 1962. So this seemingly unregulated regression, or the Shua model, it allows us to be able to take a single equation, okay, like the share of deposits in the household portfolio, okay. So deposits in the household portfolio is just one asset in the portfolio. And then we look at it in the US, the UK, the EU, Australia, Japan, and Australia. So basically, a single equation, a single equation, right, which expresses each asset in the portfolio of the household is estimated across 5 countries as a system. This is so important because it allows that if we take the major OECD economies in the world, okay, the UK, the US, EU, Japan, and the EU. I know EU is not a single country, but it represents a system of economies. And we can be able to say, okay, this is currency, how much currency in a sort of portfolio, okay. Possibly my own currency in the portfolio is almost going to about 1% or less than 1%, because they don't hold currency anymore. Okay. So it will be the case that basically you are looking at how does this coefficient, like gamma 1, the coefficient of the elasticity of currency, okay, the price of currency, or the price of deposits, like deposit interest rate, gamma 1,2 in the US, compare with gamma 2,2 in the UK, compare with the gamma 3,2 in the EU, compare with the gamma 4,2 in Japan, compare with the gamma 5,2 in Australia. That's the interesting bit we are trying to find. Okay, so we are trying to look at the assets within the portfolio of each country and trying to see how they affected. And then we have in each equation the impact of fintech, theta 1. So theta 1 standing for the US, theta 2 for the UK, theta 3 for EU, theta 4 for Japan, and theta 5 for Australia. And then we have the other variables, and you can include in so many variables. We have various control variables, and of course, those are included in the model. But the basic story, what we are trying to track through the storyline, is basically how fintech is changing the configurations of the demand for a particular assets within the portfolio for given households. So that's the empirical model. Okay, so now in terms of measurement is so important because as researchers, we may configure a way of changing the measurements of variables or innovative measurements of variables to be able to go right to the heart of the matter. But we'll start with the price sensitivity variables, simple in financial economics. Basically, you can look at prices in the driving for interest rates matter rather than volumes, which are quantities or looking at currencies or volumes. Okay. So, price clearing mechanism using prices. And so the price of currency is the inverse of the inflation rate. Okay, easier to measure. The inverse of the inflation rate is the price of currency. The price of deposits is the deposit rate. The price of debt securities is the government securities yield. And the price of equity is the rate of return for the main stock market index. Okay, say the FTSE 100 or the FTSE 500. And then the price of loans is the loan rate or the lending rate. So the price sensitive variables are easier to measure. We could make innovations in this, okay, but this was straightforward. We could distinguish between real and nominal. We could have various configurations. We could take a bank rate, justified by deposit rate. We could take the lending rate, the interbank market rate. So there's a ways one can configure this, but we thought this would be kind of straightforward configuration of the variables in question. How am I doing Athina for time? I think we also include in a model non-price sensitive variables. These are parts of the configuration of the model because we have to include, for example, expenditures, the natural log of expenditures, log of constant consumer spending base year 2015, and saying the global financial crisis, we are looking basically at the period before and after, so that we have this period as 0, as 1, and 0 otherwise. The exchange rate is an important variable here, the log of SDR per local currency unit. Again, this could be different because we could have taken the dollar, but the dollar, of course, is one of the variables for the US. We have the US, so we can take the dollar. And then for fintech, we calculated a fintech proxy. And I'm going to mention something about this. How do we measure the fintech proxy? Because actually there is so much literature now on financial technologies, but I think we are still experimenting quite a lot with the right way of measuring the developments in fintech. Okay, so this is just owning up the fact that we are using so many different measures. We haven't converged on even have a pecking order of this. So we try a number of these country-specific standardized averages based on the following variable. The first one, we use the internet to pay, where the internet is used to pay bills in the past year. The percentage of respondents using the internet to pay bills. We use that, and we have used it in a previous paper with Aisha Demir a couple of years ago, 2 years ago, actually. The second is to use a mobile phone on the internet to access financial institutions' accounts. That, again, is available in the FIDEX database of the World Bank. We also use whether digital payments were used in the past year to make or receive payments. Again, that's in the FIDEX database. But we also use the debit card ownership, credit card ownership, number of ATMs per 100,000, and the number of TM. If you are thinking of another measure of fintech that is on your radar and which we haven't invoked, please suggest so we can have a look at it. Our data sources, the flow of funds data, we had a lot of headache actually here. We had a whole team, and I want to thank some members in this audience who were part of the team of collecting flow of funds data for the OECD countries. So for the flow of funds of the US, they are published by FRED, the UK published by ONS, the EU published by ECB, Japan by the Bank of Japan, Australia, and then we have to do synchronization, testing synchronization of these databases from different countries so we can use them, same database. It's quarterly data from 1990 to 2020, and yeah, as I said, we synchronize different data sources. And we use the fintech variables as mentioned on the previous slide. So first of all, we just try to explain our configuration, how we see the sources and uses of funds for the household sector across currency, as you see, in the OECD countries, currency being a small proportion, deposits a high proportion, government securities, and then equity. And in terms of sources of funds, the loans, of course, being also a small component. The net worth has to be 100%, because that shows you that basically the system works. It is a way of trying also to measure what you don't see. Okay. So this table shows you the mean share of wealth for users and sources and use of funds using the data we have collected. Okay. So now let's share some preliminary results in here. Now, in terms of we start by having a seemingly unrelated regression or zero estimation on the share of currency. As you could expect, the share of currency is dwindling almost in all those economies. So we don't really get a huge, huge impact of fintech variable, somewhere declining almost to zero. The second was to look at the sure estimation of the share of deposits in the portfolio of households. And we find, yes, fintech actually has a positive, significant impact on the share of deposits. So that basically it is consistent with the argument that the fintech revolution, the use of these fintech instruments, is changing the way households are making deposits. And the total sum of deposits in the portfolio actually goes up. Okay, that's a positive message. But this only happens in Australia and the EU. The impact on a UK, US, positive but not significant. So it is muted. We don't want to certify it. But here is a clear indication in the context of Australia and EU of this positive impact on deposits. And what about in terms of debt securities of various we find debt securities, fintech is important for debt securities, but we get conflicting signs. We find in the US that actually fintech is reducing the share of debt securities in the entire portfolio for households. But we find the UK and Australia, fintech is increasing the number of debt securities in entire households. We argue that we would need to do a further configuration, a disaggregation of the data, because it will depend on the number of debt securities. We would want to, what we are doing now is trying to distinguish between, for example, company bonds, which have a high return but high risk, with the government securities like treasury bills and government bonds, especially say government guaranteed government bonds, which have a low return and the lowest risk. Used to be configured that the risk is zero. We know it's not zero anymore now, but at least I think the dichotomy between US and UK and Australia lies in the nature of the securities being held. And then we find, with respect to the share of equity, fintech does dramatically improve the holdings of equity in the total household portfolio in the US. But it is also in the US where households have a traditional culture of buying shares and holding a company equity as part of their portfolio. In the rest of the economies, we do not find an impact. We indeed find an impact of a negative impact on Australia, which again might be the nature of equity being traded. The share of loans comes out actually very, very, very important for loans. We find that for loans, taking the US, taking the UK and Japan, we find that fintech actually is increasing the share of loans in the portfolio. What would say that basically fintech enables the increase in the demand for loans, that fintech serve the role of being used as loan instruments using the fintech revolution in these three countries. So that's our finding, our major findings. And we find that even in terms of size, we find that the size is almost the same comparing UK and Japan. So we can actually also impose restriction on these two and to see how this the whole system behaves, assuming homogeneity of preferences in the UK and Japan. In terms of okay. Now we have so many tables in the appendix because we are trying to find alternative interpretations. We are trying to do robustness tests and other configurations of the data because, for example, as you saw in fintech, we have so many different measures. But this estimation represents the first definition of flow of funds. Basically where you have where you are looking not at seemingly unrelated regression. Seemingly unrelated regression, we are taking one equation and estimating it across a number of countries. Here we are taking all the 5 equations in the system. The 5 equations: share equation, the currency equation, deposit equation, debt equation, equity equation, and loans equation, and then estimating them as a system. Okay, and ignoring the differences in countries. Now here we find something interesting that basically fintech is reducing the share of currency. This is consistent with expectations that individuals are moving away from currency to other assets in their portfolio. But also tends to reduce the share of debt securities. And maybe this could be company bonds, which are highly risky, and using debt instruments for treasury bills and other government bonds, and that actually the share of equity and the share of loans goes up thanks to innovations in financial technologies. So just a conclusion. Apologies, I'm taking longer than I thought I would take. So what we concluded is just the observation that true, yes, fintech is revolutionizing financial services value chain. And the impact on the behavior of economic agents, that's households, firms, governments, banks, the rest of the world, is not well known, and especially on households. So this is why we focus on the household sector using an almost ideal demand system framework, and then look at the impact of financial innovations on these demand systems. What did we find? We find that fintech has important impact on household portfolio decisions. We find, for example, fintech increases demand for as deposits, the share of deposits within the household portfolio. But in the US, fintech has a negative impact on the share of government securities, but a positive on the share of equity. So there could be some way of an element of suggesting that actually households in the US may be doing some heavy substitution. Fintech also increases bank lending, as we can see that loans in the US, UK, and Australia, that impact of fintech increases, bank loans. Okay. And so in the next steps, we need to explore the drivers behind the cross-country, variations. We need to explore more proxies for fintech beyond the simple definition of fintech we have, and also control for the pandemic period, see whether the pandemic has increased demand for fintech. We know on the basis of anecdotal data that the use of fintech has increased, but we want to see whether it has increased across all the 5 assets that we are considering in a household portfolio, and whether this would pose, of course, great prospects for a recovery from the pandemic and offering new opportunities for greater fintech innovations. Thank you very much. Okay, so let me come back to Okay, so I can stop sharing. So now I will see whether do I have any okay, this at 2 p.m. So yes, Hong, thank you very much for coming. And then I can see, okay, yes, we have Professor Joshua Abo from University of Ghana Business School. So yes, I can see your hand. Please unmute and share your contribution.
All right. Thank you very much, Victor. I think this is a very narrative study. I just want to understand the nature of the data.
Yeah.
So fintech and asset prices are the macro level, right? But the portfolio choice will be at the individual level. If I understand.
Yes. This data is at the country level, but broken down to represent the components for households rather than companies, rather than companies or banks. So it's household level data.
Household level data. Okay.
Yeah.
And with the deposits, will this be fixed deposits or general deposits? Because general deposit is not really an investment. If you take the other assets, those are investments. So you make an investment decision to put your funds in equity or fixed deposit or government instrument and so on and so forth. But if the money is sitting in a current account, it's not an investment. Money is kept in current account and then you take an investment decision. So I was thinking that the deposit should be limited to fixed deposits as opposed to general deposit.
Yeah. Okay. Thanks very much, Joshua. I think that is a point where we need to do a lot of clarification in terms of interpreting, the assets. In the demand for assets, the reason why they sum up to 100, or zero when you subtract assets minus liabilities equal to zero, is because we think that if, say, a household, okay, like the Joshua household, you are thinking in terms of what money do I hold in terms of currency, how much money do I hold in terms of equity, how much money do I have in terms of bonds, okay? But in talking about this, you also need to take about that basically your worth, your total worth, includes the loans you have taken, and also include the fact that you have deposits. For example, it may be possible to substitute, okay, within your portfolio, to substitute and reduce the amount of deposits so that you can buy more equity, or reduce the amount of deposits so that you can buy more bonds or treasury bills. Okay, so that context, that basically whatever goes into that configuration is within your portfolio. Within the portfolio, some values have positive values, some values have negative values, because you owe some values you owe a loan to the bank. Okay, this is the configuration of the flow of funds configuration. Yeah, we basically think in terms of both sources and uses of funds are configured, and your whole portfolio then balances to 100%, so that asset minus liabilities will be zero. Okay, this is the configuration behind it, and I think we need to find a way of making it absolutely clear and try to see what are we estimating. Is that basically fintech is going to change all those decisions. It's going to change your decisions to hold some assets. It's going to change your decisions to hold the assets of other entities, but it will eventually your portfolio may not change, but the configuration, the way you substitute your assets will change. The extent that maybe a currency will reduce to almost 1%. I think most of us are going to this scenario whereby our currencies, currency holdings in terms of, do I have any pound in my wallet? Maybe not today. Okay. And of course, you have other assets of configuration.
Okay, that's fine. Looking at it from the balance sheet and accounting entity, accounting equation. Yeah, I think it's clear.
Thank you very much. But I think, yes, I need to do some kind of clarification to make that point absolutely clear. Yeah. Okay, and thank you, Josh. Yes, Vasilios. I hope I pronounce your name very well.
Oh, perfectly correctly.
Yeah, okay. Yeah,
Victor.
thank you.
So thank you for the insightful presentation, and congratulations for the work to you and Athina as well. Anything on fintech, I think, is very, very topical these days. So I was more interested on the heterogeneity of fintech across the countries. And sometimes, I mean, when you were showing the results, I found interesting that so fintech obviously does not need to have the same impact on all countries. And specifically in the US, you said that it increases the loans, but in Australia and European Union, it increases the deposits. And actually, this is very nice result, I think, because it could be linked to the channels of fintech that you have initially. So, for instance, in the UK, I'm aware that we have some apps like Moneybox or something like that that allow you to make deposits. So it's like a fintech provider for deposits. But in the US, this kind of a fintech approach that is a little bit not as personal is not as common in their system. So because they have more banks and they would like to have a more personalized touch. So that might explain why fintech would not rise deposits. So obviously, these fintech deposits are classified as wholesale deposits in the US banking system. So again, very, very nice result, I think.
I very much thank you, Vasilios, for that absolutely helpful comment. I think your interpretation is quite helpful because of the non-homogeneity of asset apps and the use across the various countries. We try to see how we can account for that heterogeneity. Even if we control the definitions, because we have so many definitions, but when we come to tables, we actually don't give which definition we are using for. We could take up any one of those definitions, but on the tables, I'm not sure that we have clarity in terms of what definition are we using in what table. That's number one. But even if we did, still the heterogeneity would occur that even within, say, supposing you are using a simple definition like the ATM, which was one of the definitions, okay, still I think the practices would vary in different countries, which may account for some degree of heterogeneity and differences in the results. So
yeah, so if they do not agree, then we need some rationale how to explain it. I mean, with the fintech proxy seems fine. It needs more story on why the US is different than EU, for instance. But with the channels that you have, I think it makes very nice sense.
Thank you. Yeah, I think we explore that very much. Yeah. Okay. Comments, observations. Let me see whether we have something in the chat. No, the chat is empty. And the show of hands, nothing yet in the show of hands. Yeah, okay.
I have something here, Victor.
Yes, please go. Yeah, I was actually going to invite you, Athina. I was going to say that Athina presented this paper much more convincingly recently at an international conference. And let me give her a chance to say something about and of course she did a lot of heavy lifting for this work.
So building on what Vasilios just said, one of the next steps should be to explore why we have these cross-country differences on the effect of fintech. So what are the drivers behind different effect of fintech on deposits, for example, that Vasilis mentioned between different countries? In fact, with deposits, we document a positive effect, but still not of the same magnitude. So it's much larger for the EU than it is for the Australia. There can be a number of reasons behind that. For example, one of the drivers behind fintech increasing the deposit base for household has to do with a recent trend nowadays that actually there have been a lot of M&As between banks and between fintech providers. And actually these give the banks the opportunity to expand their deposit base. Also, because of fintech, banks can leverage these technological solutions and they can offer simple and more efficient banking products. For example, mobile payments, e-banking, etc. And these solutions are able to better attract customers because those customers value the ease and convenience, and thus this translates into a larger asset base for a larger deposit base.
Thank you very much, Athina, for those additions. And I think very convincingly so, because the MA initiatives, the mergers and acquisitions in the bank sector, are rapidly, especially in the OECD countries. Actually, we observe some of those in the developing world. In fact, my hypothesis is that as part of transitioning, part of rapid recovery in many banks in Africa and Asia, will require some M&A to be done. Any central banker that is not thinking about M&A across the banks is possibly burying their hand in the sand. It's something that works, and especially two forces. One is, of course, the COVID-19 impact, and of course, the advances in technology will require that some of the old established methods of banking won't work. So yes, I think those forces, we need to recognize them in the paper and to continue taking them into account. Thanks. Yeah. So yes, Adelapo.
Yeah, good afternoon, sir.
Yes, good afternoon to you.
Yeah, good afternoon, Athina. Thank you very much for this paper. Quite interesting, and could really draw some interesting things from it. I think for me, who is interested in financial stability, I could see a direct applicability, relevance of this paper when it comes to understanding how households change the composition of their assets, especially when there is financial crisis. Because what we noticed during the COVID period was that especially in sub-Saharan Africa, there was a rapid substitution of currency for fintech, for digital currency, and it was born from the fact that most people in developing countries they couldn't get dollars make payments for international trades, and so they had to resort to, all this digital currency. And it's quite interesting to see how the financial crisis, drives, how the composition of this assets, especially in software. And again, I would like to draw attention to the fact that, the fact that you're even looking at, across different currency countries, we should also be mindful that, the level at which each country embrace, digital currency and, digital finance differs across currencies, across countries. So it will be interesting to see how financial regulation, especially how the extent to which the regulation in each country embraces fintech, how it impacts, the composition of household assets. But in all, it's a wonderful paper. We could draw so many questions from it, and we can probe further. Thank you very much.
Thank you indeed, Delapo. I think you very well touched on a number of very important points. The first one is, of course, for us to document the increased use of fintech during the COVID-19 lockdown. I know Athina has been checking some numbers here. I don't know whether at this stage there's something to invite her again to say something, if there is any insight into this. The second point you mentioned is also absolutely important, the financial regulation aspect of it, because that's one thing that is rapidly changing. And I think if you take the entire span of our database, financial regulation has actually changed so much during that period. The journey from Basel I to Basel II, Basel III, the discussion around emergence of Basel IV, even when Basel III is not yet entrenched in some countries. And I was thinking, though, whether the financial regulation changes so much among the sample countries, the sample OECD countries we have. I know regulation changes so much around the world, but does it change so much with respect to UK, US, EU, Japan, Australia? The regulation is different, of course, because there are different banking systems. But say the entire configuration of, like Basel III and its configuration, the pillars used, that may not be very much a kind of difference. Having said that, we need to look into it so that we can be able to have a clear picture. And if we find that, regulatory differences occur, then I think it's very important to put in the equation. Definitely the rate at which the countries have adopted fintech is different. Has that been facilitated by changes in regulation, creation of regulatory sandboxes and others? Maybe not. But that's a very good point that we need to document this as part of this paper. Do you have something to add, Athina, to that?
Yes, Victor. I just wanted to say that I liked Adenoko's comment on the level of fintech adoption being different across countries, which is very accurate. And in fact, I know that EY has come up with a fintech adoption index, I think it's called, or consumer fintech adoption index, which is something that we could possibly look into to account for those different levels of fintech adoption across our markets.
Thank you very much. I think, yes, that index is, would be absolutely useful. Yeah. Okay. Comments, observations? Okay. So this has been a absolutely helpful and We hope that this has excited us in terms of research on portfolio preferences of households. There are all possible extensions actually to do with this work. And especially, for example, this work is for households. It could be extended to look at companies for people interested in the corporate finance and on the behavior of companies. It could be looking at just company portfolios and company portfolio behavior. Could be in banks, for example, bank portfolio behaviors. Could be government for those looking at treasuries and the fiscal responsibilities of government. So there are all these possible extensions. And our work will continue with this paper, and we'll thank you so much for your participation in this research seminar. And we look forward to welcoming you again to the seminar next week.